Welcome to the Financial Quarterback with your host, Jim Lineweaver.
Hi, I'm Jim Lineweaver, your financial quarterback since 1993. Financial markets are off to a challenging start this year as high inflation and rising interest rates have impacted both the stock and bond markets. But at a time when news headlines and investors appear focused on the negative outcomes, we're here to discuss some proactive moves investors can make to combat market volatility. Here to help me discuss a few of these strategies is Chartered Financial Analyst Travis Dragan. So Travis, where do we get started?
Well, this year's decline in both the stock and the bond market has been especially painful for passive investors. A traditional portfolio of, say, 60% stocks and 40% bonds has declined over 10% year to date, which is on pace for its worst year since the 2008 financial crisis.
While it's not a good start, however, with the right professional advice, investors can be making proactive portfolio adjustments to better suit the current market environment. So Travis, what are some of these adjustments that people can make?
Well, some of these adjustments might include implementing positions within investment portfolios that can benefit from this rising inflation trend. And also within equities, shifting from areas of previous leadership, such as consumer discretionary or technology, and into areas that are proving to be winners in this new market environment. And also focusing on some higher yielding dividend stocks and higher yielding bonds.
And you mentioned equities, which for the longest time, over a decade, investors have been able to rely on growth areas of the stock market for leading market returns, but it's actually really shifting towards value.
Right, and while those areas of the market may remain challenged, prospects for other areas of the market appear to be brightening. And some of those areas include the natural resource sector, the energy sector, and some companies that are less economically sensitive, such as tobacco producers, food producers, and some of the large cap pharmaceutical and drug companies. And also companies that have been able to pay high and consistently growing dividends.
Yeah, those dividends that you mentioned. So if you have a good diversified dividend portfolio, that could yield you maybe 3 to 4% with the potential for dividend increases over time. So because dividends also represent 40% of the stock market's return over the past century, we want to continue to focus on income as an important component of the total return.
Right, and sticking with that income focus, because of those price declines we've experienced in bonds on a year-to-date basis, high-quality U.S. corporate bonds now offer investors a close to 4% yield versus only 1.75% 12 months ago. So for the first time in several years, the U.S. bond market is actually offering investors a pretty attractive interest rate.
And that's a great point. Thanks, Travis. And as always, diversification and a team approach remain very important. So we're lucky to have Travis as part of our investment committee, where he's joined by other experienced CFAs who work with our advisors and clients to help tailor customized solutions for them. So thanks again for joining us, Travis, and for helping me to explain some strategies for the current market environment. If you're concerned about market volatility and want to learn more, or just have questions about your portfolio, give us a call. Here's Fox News Sunday.